Good morning. Good morning. Good morning. Good morning. Apologies, guys, for the music running a bit long. I had some technological issues with the podcast stream getting started this morning, but that is a-okay because listen, we don't panic. We don't ever panic. We just switch it up. We pivot. Now, good day to you guys. Good day, friends. Listen, we've got a lot to cover today because we're talking about one of my favorite things about financial literacy, taxes. And I got a lot to get off my chest because so many people think that they're doing the right thing and they're not. They're actually not. And I have to fight and argue with people sometimes. I'm like, I was working with the IRS for like 2 years. I know what I'm talking about, right? I got certified. I did all these things to be able to learn these things for, years ago. I've been talking about taxes for 10 years. 10 years. And one of the most underrated thing about your retirement plan is probably the taxes. Most people are not as concerned as they should be about taxes in retirement and how taxes weave into their retirement plan. So today we're going to dive into some good understandings. We're going to break down just how simple this can be, as well as I'm going to give you a handful of suggestions. We got some client examples and things like that today. So if you guys are ready, I'm ready to get into today's episode as well. So just to kind of get a little bit into it, I want to just talk about why I think taxes are so underrated before we dive into it. The reason I think taxes are so underrated when it comes to retirement is because we don't really understand just how much taxes affect us. We don't understand just how much taxes affect us, unfortunately. And that is such a major problem because right now, most people think about is tax prep, as in preparing my taxes every year. That's like the only dimension about taxes that people know. They don't understand that there is tax planning as well. That's a whole separate side of taxes. They only think about the one-dimensional, I pay taxes every year. And that's only one piece of the tax puzzle. And that's not even tax planning or for retirement at all. The worst part about all of this is that if you feel like I am just going to pay taxes all my life, every year, and that's it, your life is going to be miserable. You're never going to build any wealth. If you actually believe that you're going to pay taxes, that you have to pay taxes every single year, paying taxes isn't the same thing as most people think. Paying taxes doesn't mean paying taxes, like giving the government, giving the IRS money. That's not what paying taxes has to mean. What if tax return time instead didn't have to be this massive gift giving where the IRS gives you your money back that they just held from you all year? Like what if it didn't have to be that? Because it doesn't have to be. You can actually plan to not pay any amount of taxes in the future. You can actually get to a point where you don't even pay taxes at all, where you're not even in a tax bracket. Did you know that? You could get yourself to where you're not in any of the tax brackets. Why get to a higher tax bracket? What's the point of that? What's the point of being in a higher tax bracket? So you could give more money to the IRS? That's stupid. Wealthy people aren't trying to get to higher tax brackets. They're trying to get to 0% tax brackets. So I hear it all the time. I hear, especially growing up in the Black community, we want to make more money. Everybody wants to make more money. But we even talk about, I'm getting into the next tax bracket. Yeah. Tax brackets are not a badge of honor. It's not. It's a badge of incompetence and illiteracy. That's what it is to me, at least, when people talk about wanting to get into a higher tax bracket. You should be trying to get to a lower tax bracket. And that's what we're going to talk about today. How to get to a lower tax bracket. I mean, honestly, you should be in a 0% 0% tax bracket. At least if not now, during the accumulation phase of your life, right? We talked about accumulation phase of your life as in the time where you're growing your retirement funds. At least if not in the accumulation phase of your life through business income, right? 1099 incomes and such. Then at least in the distribution phase of your life, which is after you retire, the distribution phase of your life, you should 100%, if at all possible, be in a 0% tax bracket. But most people don't know that they're going to be paying taxes already in retirement. They don't even know that. Some people do. Some people understand, oh, I got my 401k and I got to pay taxes on that. Maybe not. What if you didn't have to? What if you did not have to pay taxes on your 401k money ever? Ever. What if you put $12,000 a year into your 401k before taxes, right? So you don't pay taxes on it now. And then in retirement, you pull money out of your 401k and you don't have to pay the taxes on that money. What if? All I got to say is I get so exhausted of people wanting to be in a higher tax bracket because it does nothing for you. And then also so many people don't plan. They only prepare for this upcoming year. There's a difference between preparation and planning when it comes to taxes. There's a huge difference. Preparation is you are preparing your income tax return, right? Planning is actually planning for your future, right? So don't worry. We got that blueprint here for you. But I just needed to briefly talk about why I feel like tax is so underrated and undervalued prior. Make sure my microphone is still working. Yeah. So let me go ahead and pull this up. There we go. All right. So as we've been talking about over the last few episodes of our podcast, we are currently going through a financial literacy series. Normally, we don't dive as deep into finances like we have been, but as I have gotten a comment on one of the episodes recently, one of my episodes where I discussed that we need to be working our way out of poverty taxes, there was a comment that said that we need to start teaching people that the system is a problem because people don't learn financial literacy in school. Well, no. The system is not the problem. Are there systematic problems? Yes, but the system is not the problem. The problem is the fact that we use that as an excuse or as a reason to not learn financial literacy. So in that case, I'll just teach it. And now you don't have that excuse. So let's talk about the next basic principle of money, which is taxes. We've covered all this stuff. So if none of this stuff looks familiar to you, you definitely need to go back and watch and listen to my last few podcasts. But actually, I need to make sure that the episode is still running because I'm having some issues on my side. Yes, beautiful. All right. So these are the 3 tax buckets. These are very simple to understand. All this talks about are the times at which you pay taxes. Now, there are so many different types of accounts, so many different ways that you can be paying taxes, but we're going to break it down. All taxable events are all broken down into 3 buckets. Now, I teach this to my clients, and then afterwards, they're like, bro, what? So most people, let me go ahead and pull out this. Most people are very familiar with 1, maybe 2 of these. Well, actually, most people are familiar with all 3 of these. And I'm going to put these in terms for you that makes a lot more sense. All right. Just want to make sure that was working. Yep, come on back. All right. So most people know about these, and I'm going to put them in very simple terms for you as well. So these 3 tax buckets are where you can place your money at in different ways, whether it's place your money directly in there and in an account to grow, or just putting your money somewhere. The taxable bucket. This is these type of accounts you're going to be taxed every year on. So when you make money, like you make your income, let's just say you make $50,000 a year. Okay, so you make $50,000 a year, and of this $50,000, let's say that you put about, I don't know, $5,000 into some sort of taxable bucket. This can be things like savings accounts or maybe mutual funds. Every year that your account grows, you're going to pay taxes on that money. As an example, let's say you put this into a high yield savings account that is growing at 4%. If the account grows at 4%, let's say it grows by $20. Technically, you're going to be taxed on this $20. You're going to get that 1099 div dividends form and pay taxes on that from your bank. You're also, the exact same thing is going to happen if you have like mutual funds, for example. No, go back. If you have like mutual funds, for example. You see why I don't draw here? See why I don't draw on here? Okay. Same thing if you have mutual funds, for example, right? You're going to have to pay the capital gains tax if this goes up to, let's say, like $5,500 or so, right? You have to pay capital gains tax on that. So you're essentially going to pay taxes on that $5,000 initially because it was part of your income. And then you're going to put it in this account. And if it grows, you're going to have to pay tax on it again. That absolutely sucks. All right. So recap of taxable. In a different example, you make, okay, all right, hold on. I'm just going to draw on my screen. All right, so you make $50,000 this year that you're going to pay taxes on to the government, all right? That you're going to pay taxes on to the government. And then of your already taxed money, let's say now you've got $45,000 left after you pay taxes, right? For example. After that, you take $5,000 and you put it in a taxable bucket. If it grows, you're going to pay taxes on that money again. All right. So this is not common for people who are not saving money somewhere. This is not common for people who are not saving money somewhere. What I mean by that is if you are actively saving money to some sort of account, then you're going to be this is going to be the situation. This is your reality. You're constantly you're constantly paying taxes on different accounts. So that part sucks a lot because you're going to be taxed twice. Uncle Sam loves to put our money there. Now, gave you that example. This is like maybe high yield savings accounts, mutual funds, things like that. There are more accounts, but we're going to talk about that later. If you're not actively saving to your taxable tool, if you're not actively saving to like one of these types of accounts or some other ones, then you don't fall into this because your money is probably not being taxed a second time because you're not really putting your money somewhere, right? That's where it's growing. Now, let's say instead you're deciding to save to a 401k or something like this, like a traditional 401k. As an example, here you've got your tax deferred bucket. In your tax deferred bucket, we're going to say the same thing. Let's say you make $50,000. But let's just say that you decide to put $5,000 into your tax deferred bucket. Well, on your tax deferred bucket, if you took $5,000 and put it into your 401k or your tax deferred bucket, taxes are deferred until withdrawal, meaning that you don't pay taxes yet on this $5,000 that you put in to your tax deferred bucket. If you do not pay taxes yet on this, then you will not pay taxes on the total $50,000 that you earned. You're actually only going to pay taxes on $45,000 that you earned. The other $5,000 is not going to be taxed yet. Now, that's a great thing because that means that you're paying less money in taxes right now, right? Only $45,000. And then this is also before your standard deduction, right? These are also before standard deductions and all the rest of your like tax deductions and whatnot that you can take. So this is a great thing. This is an amazing thing. However, once you get to withdrawal, whatever that is for you, which most of the time that's going to be during the distribution phase of life, so retirement, whenever that happens, then you're going to have to pay taxes on that $5,000. However, it's not going to be $5,000 at that point. Hopefully, it's a lot more. Hopefully, it's a lot more. Hopefully, it's $50,000, $100,000, $2 million, right? That's the hope, that this $5,000 turns into as much money as possible. But the more that it turns into, guess what? The more money that you have to pay on taxes at withdrawal. So if this turns to, $20,000, if you pull that $20,000 out that year, you're going to have to pay tax on that $20,000. And then lastly, we've got tax advantaged. So this is where you pay taxes up front. It is tax advantage after you pay taxes up front during the accumulation phase and the distribution phase. So that means once you pay taxes on it, you don't have to worry about that money being taxed again while it's growing and while it's also being withdrawn. So I'll give an example here this way. Let's say that you make $50,000 this year and you decide to put $5,000 into your tax advantage bucket. This is more like your Roth. We are super familiar with that. We're super familiar with your Roth. So let's say you decide to put $5,000 into your tax advantage bucket. Well, you're still going to pay taxes on that whole $50,000. But $5,000 of that just went into your Roth. So maybe after you pay tax on that, you only had like $40,000 left or so. You put $5,000 into your tax advantage bucket. That's $5,000 after you already paid taxes on it. So you're going to pay tax on the full $50,000. And $5,000 that was a part of that $50,000. So then you put it into tax advantage, and now it grows. Hopefully it grows to $5 million, right? And then you don't have to worry about taxes on that new growth or on those withdrawals. So these are the 3 tax buckets that you need to become very familiar with for where you're saving your money. And if you're not saving money anywhere, first off, we got to talk. We got to figure out a way to help you get to the point of saving money and investing and planning for retirement. But second, you have to understand taxable, tax deferred, and tax advantage, because these three are very important for your tax planning. And if you do not specifically work with someone to help you get to one of these tax buckets, then you need to listen to what I'm going to tell you here now, because this is so very important. These are all the accounts of which your money could be taxed in. These are all the accounts for which your money can be taxed in. And if you are not familiar with these accounts, then these are definitely some that you want to be able to have. All right. These are some that you definitely want to be able to have. So tax now, you got checking accounts, right? If your checking account grows at all, right, which most checking accounts don't, savings, and also high yield savings accounts, CDs, right? CDs, you're dropping money into those accounts, and you're just letting it sit there and it's locked in. You're still going to have to pay the taxes on those CDs, even though it's locked in. Those are not taxed later. You're going to have to pay those taxes every year. They're going to still send you the 1099 div. Stocks, you got to pay that every single year if you invest directly into stocks. And then same thing with mutual funds. If you have mutual funds, you're going to have that capital gains tax as well. So if you're putting your money here, just know that you're being taxed once on all of your money that you earned, and then you're taxed again on any of the growth. It's not great, but you need to understand that. Then we've got tax later. For your tax later accounts, which most people are putting money into tax later accounts, if they are saving, other than tax now and tax advantage, you are saving. 401ks are the most popular tax later account. Most people do know that they're gonna have to pay taxes later on their 401k, but they don't know how much, they don't know what. And a lot of people also in their brain think, well, I'll have a pension and I'll have other money. I'll have a pension, so I won't have to even worry about taking money out of my 401k. Well, that's great that you won't have to worry about pulling money out of your 401k if you've got a pension. Hopefully you understand how your pension works. But let's just say that you have a pension, or you have something where you have enough annual income that you don't need to pull money out of your 401k. Did you know that if you never pull money out of your 401k, there's going to be what's called RMDs, required minimum distributions? RMDs, required minimum distributions. This is where the government is going to force you to pull money out of your account just so they can tax you. By the time most of us get to it, it will be 75.5. Right now it's at 73.5. But I believe it's going to be changing over the next few years. Did you know that you can save as much money as you want to, and if you just choose not to take that money out because you've got enough money elsewhere, the government will force you to take that money out, take some money out of your account every single year, just so they can force you to pay taxes on it. Because it says tax later. You're not going to avoid that. You're not going to avoid it. So you need to understand that about your account, because you might be thinking, well, I'll just pass on this whole account to my family, to my children, to their children. Or they're going to have a whole lot less money than what you feel like. You got IRAs, traditional IRAs, annuities, pension plans as well, pensions, because that money's going in before you get taxed, right? And then when you pull the money out, or when you start taking a pension, you're going to get taxed on it as well. Long-term care as well. Long-term care, whenever you get that money, you're going to have to pay tax on it, depending on the type of long-term care products that you have. And then lastly, we've got the better tax advantaged. So I cannot say for 100% that tax advantage is the number one best accounts bucket, or best bucket to have all of your money in. I cannot say that it is the number one best one, but I can say that 95% of the time it is the one that you want to be in, have all your money in. And also, two, there are some strategies. So I'd say like 4.5% of the time you want to have your money in tax later accounts. And then like 0.01%. Like sometimes it makes sense to have money in tax now accounts, like checking accounts. But we're going to dive into why I believe in that here shortly. But the reason why tax managed accounts is so important, at least for the distribution phase, that's what we're talking about. The distribution phase is because you don't have to worry about the tax growth or anything. And if your money has already been taxed, then you don't care how much it grows. You just hope that it grows at the maximum amount possible. You hope that it becomes as large as possible. That's the biggest goal. Tax later, if you got money there and it's growing like crazy, the worst thing that's going to happen is that you got to pay a whole lot of taxes on it. All right, so what kind of accounts here? Roth IRAs. People are super familiar with these. If you have a Roth IRA, then you're sitting pretty. Roth IRAs are great because of the tax advantage portion. 529Bs. If you have 529B set up for your child, that's also tax advantage. However, it's tax advantage with conditions. If your child chooses to take money out of that account for non-qualified college expenses, so like they can take it out for tuition, they can take it out for room and board, they can't take it out for like food and groceries, right? Which is something that most college kids need. I would imagine that most college kids need to eat. They can take it out for things like that, but not like their extracurricular activities, not extra books that they just want to be able to have or read, not their own reasons, but just while they're in college, right? It's for certain things, certain book, the required books, room and board, tuition, the regular stuff like that. Municipal bonds, health savings accounts, HSAs, and then also life insurance. All of these are all tax advantage accounts. If you can have money growing in any of these types of accounts, you're going to be set. Honestly, if you've got one of each of these types of accounts, and that's where all your money's growing, you're hey. But like I said, 95% of the time, there's like a 4% of the time where you do want some money in tax later. And again, I'm going to talk to you about that. But most of the time, having your money in IRA, Roth IRAs, life insurance, having health savings accounts, also great. Not as many people have health savings accounts as I think people should. And then also 529Bs, municipal bonds. I think there's a lot better products out there than those two. But still, if that's where you've got money at, then you're sitting pretty. And I'm happy. And I love to be able to work with you to make sure that everything's growing as best. Because this is a tax part, right? But there's also the growth part, which is where we talked about a couple of episodes ago. So when it comes to these three tax buckets, where are you putting your money at? Where are you putting your money? Where are you putting your money? All right, so here's why I want to dive a bit into breaking down some of these strategies and help you to kind of understand a little bit more about these. Give me just a second. Pull up my we are here. All right. So this is where we're going to just dive real deep into some different types of tax understandings, because I've taught you about the types of taxes, right? But now let's talk about your understanding of why you should be moving everything to be able to have what's called a tax-free retirement. Why you want to be able to have a tax-free retirement. a tax-free retirement. And if you want to know more for yourself about tax-free retirement planning, look at The Power of Zero or read the book, The Power of Zero. Great book to learn all about tax-free retirement planning. So let's just talk about tax-free retirement. And actually, no, stop that. Let me put this up here. All right, so I've shown you guys the tax brackets before. And again, this is why you don't want, your goal should not be to get to a higher tax bracket. What is the point of getting to a higher tax bracket when you just got to pay more taxes? Like, who actually wants to do that? You're thinking the wrong way. You should be constantly thinking about, how do I get into a lower tax bracket? Not for income, because this is just taxable income. Not all of your income has to be taxable. As I just showed you, some of your income can get deferred on its taxes. Some of your income is going to get taxed every single year as it grows. Some of your, like, you don't have, these ranges are taxable income. So if taxable is there, then there could be also non-taxable as well. So if that's the case, the best thing you could potentially do is try to reduce your taxable income down to zero. That just means that you've got so much money not being taxed because of legal reasons, right? Whether because of the amount of deductions that you take. Now, we've already talked about a lot of ways to take different deductions. Just go check out one of the later podcasts where I talked about how to be able to get out of, one of the earlier podcasts where I talked about getting out of the poverty tax, which the poverty tax, separate from this, the poverty tax is more of an abstract concept versus something that's much more concrete, like actual taxes. The goal is to have $0 in taxable income. That's going to be very difficult if you're making W-2 income, because you're not going to be able to take enough tax deductions, right? If you're only solely W-2. But if you've got 1099 income, then yeah, you can take a lot more taxes or deductions in order to be able to get to a 0% tax bracket and pay like no taxes, especially with a lot of different things that you're doing. So let's just say that this is the tax brackets right here. Now, in retirement, if you want to get to a 0% tax bracket, you can only be at $0 of taxable income. The only way to get to $0 in retirement of tax-free income is to have all of your money in tax-free accounts, also known as tax advantaged. This is because the only way to not pay taxes during retirement is if you've paid the taxes up front. That is the only way, minus one exception I want to dive into here shortly. It's the only way. So this means that in order to be able to have a tax-free income in retirement, you need to be putting your money either directly into tax advantage accounts like Roths, right? Or to start in a different tax bracket and to move it strategically over to the tax advantage bucket prior to retirement. So that way you don't have to pay it in retirement, right? Prior to retirement. So the biggest thing about this is, let's just say that in retirement, you're bringing in $60,000. This is your income. You're bringing in $60,000 in retirement. And let's say you're married, so we can subtract the $30,000 standard deduction, SD for standard deduction. you're married, so you can subtract the standard deduction. The standard deduction goes up every year based on inflation as well. So this will be higher by the time you retire. But let's say you take off the standard deduction. This now leaves you with $30,000 of taxable income. Now, let's say that this income, though, was all from your 401k, which we know is not in a tax deferred bucket, is in a tax advantage bucket. So now, since that was in we know that it's that's in a tax deferred bucket. So now, since that is in a tax deferred bucket right here, that means this income is going to have to be taxed. This $30,000 will have to be taxed. But let's say that it was not in your 401k. Let's say that it was in like your Roth IRA or your IUL. Let's say there was in an account like that where you took $60,000 out for retirement income. They subtracted the $30,000 standard deduction, and then you got $30,000 left to report. Well, that income was already taxed, so you will not have to pay taxes on it because it's not taxable income. Non-taxable. Meaning that you get to keep all $30,000 of this plus the other $30,000 from the standard deduction. So you get to keep all $60,000 of this. All right. So that's how that's how you're going to be taxed differently. Now, let's just say that instead you've got I'm going to draw the buckets for you. Tax now, tax deferred, and tax advantage. Let's say that you've got maybe $5,000 in your tax now buckets. We're going to just assume that that's a savings account. And then you've got $250,000 in your tax deferred bucket. Let's say that that is 401ks. Let's say that that's 401ks. Yeah, we'll just go 401ks. All right. And let's say that you've got, let's say maybe $50,000 in your tax advantage account. And let's just say that that's like your Roth IRA. This is, let's say, prior to retirement. So you're paying taxes every year on this account, because it grew. You're not paying taxes just yet on this account, on your tax deferred account, because you don't pay taxes until retirement. And you're not paying taxes on this account because you already pay taxes on your tax advantage account when you put the money in there. So right now, you're fine. The only thing you're paying taxes on is your tax now account every year. And that's very minor. And then also your income as well, right? But let's say that you now start retirement and you start withdrawing from your 401k. You're going to pay taxes on that every year on the money that you withdraw. So instead, what if you could just do a conversion of your account, pay the taxes on your 401k account, and move it over into a tax advantage account before retirement? So that way you don't have to pay a bunch of taxes on that every single year as it continues to grow. That's what's called a Roth conversion. You just convert it to a Roth account. Now, strategically, you will have to move that money over, right? So you likely cannot be actively still working. Most companies won't just let you move your 401k over to another account, to like a Roth IRA or to like a fixed index annuity. Most companies won't let you. You need to be able to do what's called in-service distributions in order to be able to do that. But let's say that you've left the company, right? And you've got money in different like old 401ks or you just finally left your company, you're about to start retirement or so, you could instead do a Roth conversion. And there's a ton of other strategies you could do where you're strategically rolling it over the course of like the last 5 years or so. There's all types of stuff like that. We're not going to dive into too much into that. If that's kind of your situation, if you're close to that retirement age and you want that sort of customized planning, right, you just need to sit down with my firm and we'll help you out. But again, this is just general information, general education. So in this case, you can actually strategically roll over that money, right? Now, will you get a big fat tax bill if you move over that entire $250,000 account? Yes. Yes. You don't want to do that, right? So that's where strategic planning comes into play at. But could you? Yeah, you actually could. If you moved over the total $250,000 in 1 year to a tax advantage account, you will have to pay the taxes on that money to the IRS. And let's say that now that's going to throw you into depending on your income, into a $35,000 to $32,000 tax bracket, depending on where you are, 24%. So you're gonna have to pay a bunch of taxes on that money and on that extra money, on all that money. You don't want to do that. That's why this is very important to plan ahead and have your money in tax advantage buckets. So that way you pay small amounts of taxes now, and then it grows to $250,000 and you don't have to worry about taxes. But if you are at the point where you're later on in life, then yeah, it might make more sense to be able to just move money over in chunks. So that way you pay less in taxes instead of getting to a higher tax bracket and paying higher taxes on that money. So let's say you do move that money over. You pay taxes. I'm just going to say you move over $175,000. We're now going to add $175,000 to your tax advantage account, leaving you now with $225,000 in your tax advantage account total. And then also you now have your savings, and that's it. All right. But let's say that your savings account is so small that you're not really having to pay taxes on it, right? Let's say that you take it out of a high yield savings and you just have it sitting in a regular savings. So now it's not being taxed at all. In this case, if you now have $225,000 in your tax advantage account, whether that's Roth, IULs, fixed index annuities, whatever the case is, let's say $225,000, and it grows over the next 10 years to, let's just say, I don't know, $1 million, and you start taking $40,000 a year from this in retirement. You start taking $40,000 a year from your account in retirement. That all of that money is now tax free. That's tax free. And since this money is non-taxable, this means that if your annual income is $40,000, but it is not taxable, you have a 0%, or excuse me, you're in a 0% tax bucket, meaning you're paying $0 in taxes every year. The goal is to make sure that you have no money in your tax deferred bucket while you're in retirement, except for this one exception. So I talked about the standard deduction. Let's just say the standard deduction for a married couple right now this year is $30,000. $30,000. That means that you make whatever amount of income you have, and then they subtract $30,000 from that, and then your taxable income is the rest. Well, looking at this tax bracket chart right here, if you make $50,000 and then you subtract the $30,000, you're left with $20,000 of taxable income. $20,000 is going to put you, if you're married, in this 10% tax bracket. Pretty simple, right? Because your taxable income is in between $0 and $23,000. But let's rewind and say maybe you don't make $50,000. Let's just say maybe you make $28,000 of income. Well, if we subtract your standard deduction from that, we're left with $0. We're not left with negative $2,000. We're left with $0 when it comes to taxes. Okay, you're left with $0, which now means that you are paying. You have a $0 that you have a 0% tax bracket. You are not paying taxes on that $28,000 that you made. So you get to keep all $28,000 of that money that year. Now, in real life, what's actually happening, if you are actually making $28,000, you're paying taxes during the year. Like you pay taxes out of your account, or excuse me, out of your income, or out of your paycheck every year, automatically. You do that every paycheck, every year anyway. But at the beginning of the year, when you file your tax return, you're going to file your tax return and your tax liability, like how much you actually needed to pay taxes, is going to be set to 0, which if you did end up paying taxes throughout the year, they're just going to give you all of those taxes back. So that's how that part works. Like whatever you paid, if you, for example, ended up paying, let's say $2,500 in taxes that year for whatever reason, just throughout all of your paychecks, they're just going to return that $2,500 to you because you're in a 0% tax bracket. Now, then you're like, but Charming, why would I want to only make $28,000 a year? You're thinking, that was the accumulation phase. Now let's talk about the distribution phase. What if in retirement, all of your income, except for a little bit, was in the tax advantage bucket, right? Say almost all of your income was in the tax advantage bucket. But then some of your money was in the tax deferred bucket. Let's say that you had like a 401k, or you had a 401k that didn't have that much money, but you start taking income from it of $30,000. Let's say you start taking $30,000 per year out of your 401k. $30,000 per year coming out. That's your income. Obviously, this is from your 401k, so it is a tax deferred, so that means you have to pay taxes on it. But if we first subtract the standard deduction, that leaves you with how much money? $0. So if you are pulling $30,000 out, or what's equal to the standard deduction, and that's all of the taxable income that you have, right? Because the rest of your money is coming from your Roth IRA, it's coming from your IUL, it's coming from your fixed index annuity. All three of those are tax advantage products, right? You don't have any money growing in tax now buckets, right? You don't have any money in mutual funds. You don't have any money that's growing in high yield savings accounts. You don't have any capital gains taxes like on your mortgage or anything like that. If the only income that is tax deferred, or that you have to be taxed on in retirement, is your 401k income, and it is equal to or less than the standard deduction, you will not have to pay taxes on that 401k income. Meaning that if this is every year, right? If you do this every year for 25 years, that's $750,000 in retirement that you never pay tax money on. That's $750,000 in retirement that you never pay taxes on. You didn't pay taxes on this money when you put it in, right? When you put it in, obviously, if you put in $5,000 and it grew to $30,000, right? You didn't pay taxes on that $5,000 when you put it into your 401k. But if it grew to 30,000, or if it grew to a lot more, and you're only pulling out 30,000 per year, that's less than the standard deduction that they're going to give you, putting you at that $0, which means you're going to be in a 0% tax bracket, meaning that you get to keep all 30,000 of those dollars, which means that there is some money that you can actually never pay taxes on. And that's a lot of money that you never pay taxes on. $750,000 in this example. And every year, the standard deduction increases based on inflation. Every year. So how do you plan for that? Because let's just say you only take out $30,000 a year. Well, will that be enough? Will that be enough? That's the real question. Because most people don't ever, one, know this, and two, plan for this. With those required minimum distributions that I was talking about, where if you don't pull money out of your account, the government's going to force you to pull money out so that they can tax you. Let's say your 401k is large, really large. If you're only pulling out $30,000 a year, the government might find, hey, you're not paying enough taxes. We need you to pull more money out, and they're going to force you to pull more than $30,000 out in each year, so that way they can tax you. But what if you could have a small enough 401k to where your 401k is so small that even with those required minimum distributions that they force you to pull out, that those RMDs are smaller than the standard deduction for the year. You can set up your account to where it stays that small. But now, tell me, why would I want my 401k, my retirement plan, to stay small? That's where that strategic planning comes into play, where instead, if you move over enough of your money to a tax advantage account now or before retirement, to where you have less than the standard deduction in retirement, then you're going to be great. Now, that's something that we'd have to actually sit down and plan out. But if you want to know how to find that information out, again, I talk about it all the time. Investor.gov has, if you go to financial tools and calculator, required minimum distribution calculator. It's a super simple way to be able to learn and understand what was the value of your retirement account as of December 31st last year. So you can just take the assumed amount of money that you'll have. If you don't have some sort of illustration of how much money you're going to have, then it makes this a little bit hard. But let's just say that you have $225,000 in your account at the end of the year, and your 401k as an example. Age at the end of the year. Let's say at the end of the year, you are 73 and a half, because right now, requirement minimum distributions are start at 73 and a half. Again, this should be going up to 75 and a half soon. So $225,000 at when you're 73 and a half. This is going to tell you your withdrawal factor, dividing your account value, blah, 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 blah. Your requirement minimum distribution this year is going to be $8,400 or $8,500, meaning they're going to force you to take out $8,500 from your $225,000 401k in this year. And if that's the case, if they're going to force you to take that out so they can force you to pay taxes, if that is your only taxable income, again, only taxable income, you won't have to pay the taxes on that money. That's your only taxable income because of the standard deduction of being at $30,000. Really cool, right? But let's just say your account is $1 million. $37,000, you're going to have to pay taxes on that account because it's more than the required minimum distribution. All right. Now, let's just say instead you were able to move that account, move most of this $1 million that you have in your account prior to, like earlier on. Again, we planned prior. Say you're able to move over a bunch of money into a Roth account, into maybe a fixed index annuity style tax advantage account. Let's say that case to where you did only have, let's just say, let's put that 250 back in. 250 by the time you're 73 years old, $9,400. Let me see if I can max this out. Bam, right here. Perfect. So let's say by the end of age 73, by 73, you've only got $750,000 left. Well, in this year, $28,000 is less than a standard deduction. Awesome. Let's say the next year you now have $725,000, right? Because you took out some money, $28,000. Let's say the next year you've got $700,000. You're age 75. Once again, $28,000. You're still under. So that's what the goal is to figure out how much money you need to start retirement with and properly take out every year, so that way you stay under the required minimum distribution, so that way you never pay taxes on any of this money. That is the goal as well. The goal is to get as much of your income into the tax advantage buckets as possible, so that way some little bit of income that might be in your tax deferred bucket, yeah, it's less than the standard deduction, so you'll be all good. The issue with that is if you also take out Social Security income, then it gets added to your income. And that's where, one, you now get taxed on your Social Security income, and you get taxed on your tax deferred bucket as well. So tons and tons of tax information and tax strategies. And it might be very confusing, but this becomes easier to understand when we get to sit down and look at your actual account and help you out with understanding this and what's going to happen in the future. I've got two different examples to show you of an example client. So this is an example, so not like one of my clients, but I'm going to speak in terms of one of my clients. So this is a fixed index annuity for one of my clients. Let's say he puts in $20,000. He puts in $20,000. He rolls over $20,000 from his Roth IRA into this fixed index annuity, $20,000, and then it just grows over time, and it grows to $980,000 by the time he's 65 years old. This is based on the market's performance over the last 10 years. Let's say that over the last 10 years, it repeats. It gets up to $983,000 by the time he's 65. He can go ahead and retire. But let's say it continues to grow. Instead, he doesn't take out any money. But by the time he gets to 75 and a half, he's now forced to take out required minimum distributions. At this point, he has $3.8 million in the account, or $3.7 million in the account prior. So they're going to force him to take out $154,000. Is he going to be able to avoid this $154,000? No. Or excuse me, avoid paying tax on that? No. There's no way that he's going to be able to take enough deductions for that. Maybe, but it's going to be almost near impossible, right? But do we want his account to stop growing? No. He wants to leave this account to his family. That's why he's not taking withdrawals out already anyway. But if he did not take out enough money prior, if you did not take out enough money prior, then you're going to force you to take these RMDs. And these continue to increase every year that his account grows. So he's going to pay more and more taxes. Now, is he happy with the fact that he's being forced to take out, like in this year, $700,000 that year? Yeah, he's fine with it. But the thing that sucks is that a lot of that money is going to go to taxes when that money could be going to his family instead. And then let's say he makes it to 95 years old. He will have ended up taking out $22 million from his account just so that way he could pay pay taxes on $22 million, where that $22 million could have gone to his family. So what's the difference if he chose to instead pay taxes now on the account on the $20,000? So yeah, he has to bite the bullet, and he can only put $15,000 into the account because he paid $5,000 in taxes, let's just say. So he starts his account with $15,000, which is less, so the account isn't going to grow as well, right? But let's say he gets to 65 years old now, At this point, he has $737,000 in the account versus the $983,000 that he would have had if he had left all $20,000 in the account. Yeah, you bite the bullet up front, but look at what happens at age 75. He gets to keep all the money, and if he chooses to pull it out, he can. And if he doesn't have to worry about it. But also, since the money is staying in the account, the money can continue to grow better. It can grow better. And let's say by the time he's 95, he has accumulated $58 million versus accumulated $23 million. So he has less than half if he does not pay the taxes now versus having much more. Now, when we add the two of these together, 22 plus the 23 million, then that's a total of $45 million of growth. So that means totally $45 million. He's got 23 that he has still, but he gave up 22 million, or he spent or used, I have to pay taxes on 22 million for a combined $45 million. But in this account, he has $58 million. So which is better? Pay taxes now or pay taxes later? In this case, pay taxes now. Pay the tax on that $20,000 now, put it into your tax advantage account instead of a tax deferred account. And you're going to be much, much happier. You're going to have a lot more money in this case. Again, this applies to this tax client that I made up as an example, but this is something that we see all the time. And again, you can be able to calculate your required minimum distributions yourself. As an example, let's say we go to this is our income here. We pull back up this is at 75. $154,000 is what his withdrawal factor or his required minimum distribution is going to be, which you can see right there, $154,000, 205. So because of that fact, then yes, in this example, and in this case, it makes sense to. Not all the time does it make sense to do that sort of conversion or pay the tax on account and put it into it. Not all the time, and that's where actual planning comes into play. But this is so very important to understand, or to at least sit down and see, well, where is my money? Because not everybody's going to be as advanced, right? And I can teach you these things, but the reason I'm teaching is for general education and knowledge to understand how to keep more of your money so that way you can have more of your own wealth, right? That's the biggest point, is keeping the most amount of money that you possibly can. So with all of that being said, I hope that this has been educational for you. If you have any kind of questions on your tax status, on your tax buckets, on what you're doing, a couple of different options. You've got down in the description of this podcast, wherever you're watching this at, there are links to be able to just sit down and meet with someone in my team, and they'll be able to help make sure that to answer whatever question you might have about your current tax status and your tax status in the future. There's also the Power of Zero book that you can read. Great book, The Power of Zero, that'll help you understand this much better than this little hour, like Taxes for Dummies kind of thing. And or you can just be able to comment down below, and I'll be able to help you out and give you some examples as well. Even live on podcast. If you want to remain anonymous, then I will definitely do that as well. So with all of that being said, guys, it is a beautiful day. I hope you guys have an amazing rest of your week. I will see you guys on Friday as we dive more into the wealth equation. All right. But with that, you have an amazing day. Take good care. I want you guys to comment down below on one of the things that you learned or did not know of today. And I'd love to be able to hear some of your feedback. But take great care today. Have a beautiful and a blessed day. Bye, guys.